Now here, last year and the current year, the amount of assets last year was 2 lakh rupees and the current year is rupees 4 lakh. Now the cash balance in the last year, that means the closing balance, it's rupees 5 lakh. This transaction is affected to the cash balance, let's say. Here, in case of assets is 2 lakh and opening balance and the closing is 4 lakh. Now this would affect here in reverse case, right? How much is actually having assets in the last year? That is added. So last year balance is rupees 2 lakh, which comes to 7 lakh rupees because of these are the assets which are holding by the company. Cash is debit. Assets is also debit, so debit add the 7 lakh rupees, and current year cash balance of assets would be deducted from it. Then the amount of closing cash and bank balance is rupees 3 lakh. What was your opening balance? 5 lakh rupees. Now what is the closing balance after this transaction? It's 3 lakh. So it's reduce, it decrease. Decrease, it means it's an application of fund. So in this regard, the transactions are occurred in a different way. The transactions happen among the current assets and non-current assets, whether it is a fixed assets or a permanent assets. When the transactions involving in the current assets and non-current liabilities like long-term borrowings and capital, which would be also affected in the same way for the particular flow of funds. In case of transactions involving current liabilities and non-current liabilities like fixed assets and the permanent assets, it would be affected the flow of funds. And also if the transactions involving with the current liabilities and non-current liabilities like short-term borrowings, capital, and the another part of the amount which is also affected to the flow of funds. So this is all about the flow of funds so far as concern of the fund flow statement. Now moving to the next part, that is chart shows the movement of flow of funds. See here, in financial statements there are two important statements. One is a revenue statement and other is a position statements. Position statements shows the positions of the company at the end of the year or on a particular dates. So according to that particular position statements, here the balance sheet has actually divided into 4 blocks. So the whole balance sheet is divided into 4 parts, and then how it would be affected to the flow of funds, that I want to explain. So first you just see here, the balance sheet is divided into 4 parts like block A. It is a part of a long-term liabilities that carry share capital, which includes equity and preference shares. Then reserves and surplus, that is retained earnings, whatever the amount of general reserves, capital reserves and other reserves and surplus, profit and loss account are considered under this category. Then the long-term borrowings like debentures and bank loans and financial institution. So that is actually considered under the block A. Now see the block B. Block B is carried fixed assets and investments. Fixed assets, there are 2 types of fixed assets. One is a tangible assets and other is an intangible assets. Tangible assets like plant, machinery, land, building and others. Intangible assets carry goodwill, patent, copyright, trademark and other things. And investments which are made for a long-term duration, long-term period, also considered under this block. Block C is carried current liabilities. So current liabilities includes creditors, bank overdraft, outstanding expenses or any amount of provisions made regarding the future expenses. So all this includes in the current liability. And in the current assets, that is 4th block, which is cash and bank balance, debtors, bills receivable, stock, incomes, and that's part of outstanding incomes and short-term investments. Then these things are considered under the charts of a flow of funds. In this regard, if you are going to observe this balance sheet in 4 parts, I wanted to show you something regarding the changes of fund flow statements. Here, if any transactions occur in the different blocks, whether it would be affected to flow of funds or not. See this portion. This is actually showing whether the flow of funds has occurred in the business or not. For that, I just want to tell you, if there would be any change or any transactions regarding the up to upper blocks, that means transactions is actually affect two upper blocks, cannot be affected to the flow of funds. In the same case, if it is transactions occurred in the two lower block, also not affected to the flow of funds and not to be changed any working capital. In case of the transactions occurred on one upper and lower block of the same side, that is A and C, which is also not affected to the flow of funds and the changes of working capital. The same way in the reverse side, if any transactions occurred in the block B or block D, also not affected to the flow of fund. But if the transactions occurred to cross block like A and C, B and B and C, then it would be definitely affected to the working capital as well as affected to the flow of funds. Even one more thing is that if the transactions occurred in the same block, that means both the effects are affected to the block A or maybe block B like C and D, which is also not affected to the flow of funds. Let's see with an examples how it would be affected to the flow of funds one by one. Let's see in case of if the transactions, any transactions which take place to upper block. Like an example is if the company issued shares against the purchase of machinery, then it is no inflow and outflow of funds because its increase in capital effects of block A and increase in machinery affects block B do not affect the working capital. Do not affect the working capital, how it shows. Suppose as I took a transaction that the share capital issued, which is affected to the block A, and it is issued against the machinery. That means the transaction is the company issued equity shares against the machinery. So here it would be affected to the B. If you are going to see here, the equity share capital is increased. That's right. Simultaneously, it's increased on machinery also. So that means assets is also increased. So if it is affected, equity share capital, it's increased. Simultaneously, it's increased machinery also. Transactions cannot take place in the change of any working capital, and that's why it would not be affected to the flow of funds. Taking another example, in case of if the transactions affected to the two lower block. Example is if cash is paid to creditors, there is no change in funds because of the decrease of creditors in the one side and the reduced cash balance on the other side. It affects both the sides equal with the same amount and the same value, so it does not change the working capital. Now see, as I already took it an example that the C and D, that means two lower block. The one is, the transaction is what? The transaction is the so and so amount has been paid or cash paid to creditors. So the transaction is rupees 5,000 paid to creditors. On the basis of this, see, suppose cash balance is rupees 10,000 and the creditors balance is rupees 5,000. Now see the effect. How much you are paid to creditors? 5,000. So if you paid 5,000 rupees creditors become zero, nil. That means it's reduced and cash balance paid. So cash goes out. The transaction effect is creditors account debited to cash and bank account. So creditors, here it shows on the credit side. Creditors account debit, so it's minus and it becomes zero. Cash and bank goes out, so that will be also deducted. Paid to creditors minus from this 5,000. So the balance of cash is rupees 5,000. So net cash balance is rupees 5,000, which is also reduced. If you are going to see cash and creditors, that means both the sides reduce equally, same amount. So if it is reduced equally same amount, cannot affected to the working capital, and that's why the two lower block transactions also cannot affected to the working capital. Now moving to the next point or a next transaction. That is, if in case of any transactions occurred to cross block. See here. Here I am taking a transactions A and D. Suppose the transaction is if the shares issued against the cash, there is a change or not, we need to see. Suppose 1 lakh rupees shares issued against cash. So cash balance comes in the business or not. See here, shares issued. So the journal entry is what? Cash comes in, cash account debit to equity share capital account. Now we need to identify whether it affects the fund flow or not. See here, suppose your cash balance is rupees 50,000 right now. Okay, and the equity share capital also you have a 1 lakh rupees. Equity share capital is also 1 lakh rupees. Now see the changes. Cash balance is 50,000 rupees. Here cash account is debited. So 50,000 plus how much amount of cash issued? 1 lakh rupees. So 1 lakh it's added. So now your cash balance it comes to 1,50,000 rupees. So that means that increase. Cash balance is going to increase. So D is increase. Alright, it affects. That means the flow comes in the business. And equity share capital, if you are going to see the equity share capital, that was 1 lakh, it comes to 2 lakh rupees, which actually increases in the liability side. The liability side increase in the other block. Here, the sources of funds affect the cash balance. It means it's change the cash balance, it's change the working capital, and that's why these transactions affect a flow of funds. Here, in case of any transactions which comes to change a net working capital, it would be definitely affected to the flow of funds because of the cash balance is going to change. See the same type of transactions in the other cross block, like in case of if the transaction is, suppose company purchase fixed assets on the basis of a credit transaction. That means company purchase a machinery on credit. So what would be the transaction if the company purchase a machinery on credit? That means machinery comes in, machinery account debit. 2, it's purchase on credit. That means the creditors has been created. So the transaction is machinery account debited to creditors account. Now we want to see whether this transaction affect the cash or not. See here, it is affected cash or if it is affected working capital, in both the cases it will be affected to the flow of funds. Now we'll see machinery comes in the business, so machinery increase. Why? Because of suppose you take an example, machinery opening balance is rupees 1 lakh. Opening balance is 1 lakh rupees and you purchase a machinery of rupees 1 lakh. So now your closing balance of machinery is 2 lakh rupees. So it's change. Machinery's value has become a change, opening and closing balance. Opening was 1 lakh. Because of this transaction, your closing balance of machinery is rupees 2 lakh. So it's increased. Here the fixed assets is increased in the block B. Now it is purchased on credit. So what would be the changes in the creditors? Here, according to the transaction, the creditors opening balance was suppose 50,000. Suppose opening balance of creditors is 50,000. Now what would be the change in case of creditors closing balance? Here the machinery purchase on a credit, and that's why your creditors value is also increased. This is also increased. Machinery is increased, creditors also increase, and creditors increase from 50,000 to 1,50,000. So the closing balance is increased by 1 lakh. It's change your working capital, and because of the change of working capital, it's affect a net working capital or a net assets. If it's affect the net assets, then it would be affect the flow of funds also. So in that case, the amount of flow of funds has changed, and the flow of funds change because of the cross transaction, cross block transactions from A to B and from B to C is always affect a working capital as well as the net assets of the firm. That is why it affects the flow of funds also. Now moving to the next part, that is the preparations of fund flow statements. How the fund flow statement is prepared, what are the things and what are the points to be observed and keep it in mind to prepare a fund flow statement. A fund flow statement is prepared on the basis of the informations contained in the balance sheet of 2 consecutive years. That means for the preparation of fund flow statements, the basic information is required: 2 consecutive years balance sheet as well as a profit and loss account for the specific period concerned. So if you take it current year, then you need to have a balance sheet and profit and loss account of the last year only. The major purpose of the fund statement is to provide detailed presentations of the results of financial management as distinguished from the operating management. That means we need to observe the comparison of the financial management and operating management, and outcome of these differences or differences from it, we need to identify whether there would be any change in the flow of funds during the year or not. It is a report of movement of funds which during the accounting period. So whatever the changes of funds occurred during the period, it would be reflected here. It is to be considered that only those transactions should be incorporated in this statement that affects the net working capital. That means if it is not affected to the net working capital, cannot be considered in this report or in the statements, as we already discussed in the previous part. So how the transactions are affected and which transactions are not affected to the flow of funds. A fund flow statement is the statement of sources and application of funds. It evaluates different sources from where the fund is collected and applied to. So the fund, we need to identify the sources of funds and the application of the funds. The fund flow statement summarizes the significant financial changes which have occurred in the accounting period of the company from the beginning till the end of the year. Ultimately, whatever the changes are occurred in the financial transactions from the beginning to the end of the year reflected in your report or in your fund flow statement. Fund flow statement can be defined in 2 ways. The statement is prepared the 2 parts. The one is the sources of funds and the other is application of funds. In this regard, it prepares in a T-shaped form. It can be prepared in 2 formats. One, it's a T-shaped form like this. So on the left hand side, all the sources of funds would be recorded, and on the right hand side, all the application of funds would be recorded. And it concerns the another format also, that is a statement format. In the statement format also, that the fund flow statement would prepare that the sources of funds would be written first and all application of funds would be written on the second part, and then sources and application of funds would be compared. So this is the another method of the fund flow statements. Now here see which are the sources and application of funds under this particular chart. Here under the sources of funds, that if the company issued equity share capital, then preference share capital. If the company issued any long-term borrowings, it is not issued rather, if company take it any long-term borrowings, like if they the borrowed bank loan and financial institution loan, right? In case of the any amount of assets and investments sold out during the year, then the funds from operations, so that means any amount of profit, operations means profit, from the profit and loss account. So any profit also would be recorded here in the part of fund flow statements. And very important part is decrease in working capital. So in case of working capital is decrease, that is also the sources of funds. These are the sources. Now which are the part of application of funds? In case of redemption of preference share capital, that means the preference share capital are redeemed and to be paid to the preference shareholders. Redemption of debentures, if you paid bank loan or financial institution loan, if you purchase any assets or investments, if you paid dividend and tax liabilities, which is also recorded under this application of funds, then increase in working capital, rather net working capital. Here also the net working capital. If the decrease, it would be considered as a source. Like this. In the case of decrease in working capital, it's a source. But in case of increase, it's an part of application of funds. So these are the items would be recorded in case of increase and decrease and the changes of flow of funds in the sources of funds and application of funds. So this is a pro forma of a fund flow statement. Next topic is the significance of a fund flow statement. Significance of the fund flow statement is all about how the fund flow statement is affected to the business, enterprises, organizations, for the managerial skill, for the managerial level, and for the future planning and development of the organizations. A fund flow statement is prepared with an objective to understand about the changes in working capital and another financial transaction. So the fund flow statement is all about how the working capital has changed, and due to the financial transactions, what are the changes of flow of funds. It is a useful tool and technique in management accounting